Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Dode, and today's guest is a returning guest. Is John Rubino. He's the editor of the dollarcollapse.com and also a co-author of The Money Bubble. John, thank you for coming back on.
Hi, Mo. Thanks for having me back.
I don't know if you have read or seen this, but I've noticed it a lot lately. But apparently, taxation is theft.
Taxation is death?
Theft.
Theft? Oh, yeah. I've heard that.
I've seen a lot of people say that lately. So I mean, I definitely agree with that.
Well, that's a kind of a standard libertarian and, of course, anarchist point of view. I tend to think government should exist to protect property rights, and we do have to pay for some functions, so not all taxation is theft. On the scale that it happens today, of course, yeah. Especially if you include the dishonest forms of taxation like inflation, where they secretly take money out of your savings account by making the dollars there less valuable, and then give it to rich people, basically, because government serves right now to basically funnel money into the big banks more than anything else. And so, in effect, when they secretly tax your savings by inflating the value of the dollar, they're giving that money to Goldman Sachs and J.P. Morgan Chase and the Democratic National Committee and the Republicans and the political class and the financial class, in effect. So we're long past the point where government is doing a few things very well and protecting our civil rights and protecting property and not much else. And so that's the source of the financial crisis that's coming. Government has grown and grown and grown and borrowed and borrowed and borrowed and convinced its citizens to borrow until, as a society, we're so over-leveraged that some kind of a crisis has become inevitable, and it's going to result in a mass devaluation of all the major fiat currencies out there. That's basically what we're looking at over the next few years. And so, I think you can trace it back to government running out of control by giving itself a printing press in 1971. And until we go back to sound money and limited government, we'll always have these kinds of problems.
What's funny is that the year that the Federal Reserve was created, which is 1913, they also implemented the income tax as well.
Yeah, those things go together.
Yep. So, yeah, I agree with you there. Inflation is taxation. A lot of people on Main Street don't realize that. Yeah.
A lot of things people don't realize that I think gradually they will. That's a big part of this process is people figuring out that the big systems don't work for them anymore and then acting accordingly. In the Austrian School of Economics, there's a concept called the crack-up boom, which basically takes place when a critical mass of people figure out that government policy is explicitly lowering the value of the currency year after year after year. Inflation is something that's not a one-time thing. It's not going to be fixed. It's going to continue for forever, basically. And they no longer want to hold the currency because they assume it's going to lose value at an accelerating rate, and they dump it whenever they get it, and they turn it into real things. They buy stuff with their paychecks as soon as they come in, and this pushes the prices of things up, which looks like inflation, but really what's happening is a mass loss of faith in the currency. So that's one very possible scenario for the end game here, that everybody just loses faith in these fiat currencies. And we see the prices of real assets start to just go through the roof. But what's really happening is the value of our currencies are plunging. And so, that could happen. There are lots of ways for this to unravel, but that's one very possible way.
So I want to talk about the Federal Reserve for beginning portion of our podcast. They recently released their meeting minutes or notes for their FOMC meeting. As of now, they are talking about increasing rates in June. I just want to get your thoughts on that.
Well, they might increase rates in June. I think over a slightly longer period of time, they're going to have to be cutting rates because the global economy really isn't growing. And the U.S. every once in a while will report a monthly number that looks favorable, but then it's usually reversed out by revisions in subsequent quarters. And there's really nothing going on here. The manufacturing industry is weak, and a lot of formerly hot housing markets are starting to roll over, and it goes on and on. And all that happened in the last month was that oil prices went up, and that inflated some consumer spending numbers, and that's not much of anything. So the Fed would like to raise interest rates to give themselves some ammunition for the next downturn so that they can cut interest rates from 4% to 1%. And in that way stimulate the economy and hopefully moderate the severity of the recession. But if they're starting at half of 1%, there's not much room to cut. And so they feel like they don't have ammunition and would like to build some up. But if in the process of doing that, they strengthen the dollar excessively and crush corporate profits and send U.S. stock prices down, and that pulls the global economy down, which it could easily happen if they raise interest rates, they'll reverse course in a heartbeat, So if they raise interest rates one more time, I suspect there will be a market tantrum, and that the Fed, by the end of this year, is going to be actively cutting interest rates. Because when you look around the world, our rates are higher than most other countries. There's negative interest rates all around the world, and not much of that here in the U.S. yet. And you would think that our interest rates would actually be lower than other countries because we're probably, it's amazing to say this given our finances, but we're the best credit in the world right now. And so I think there's a good chance that if we try to raise interest rates, we'll just invite in a deluge of foreign capital that'll push our interest rates back down. And we'll be back down around German levels or Japanese levels, which are negative all the way out to like 10 years on government bonds within the year. So I think that a lot of the things that governments are trying right now are emphatically not working. And again, it all changes when people figure out the governments don't have any tools left that can actually keep quote unquote normal times rolling. In other words, maintain a situation where people are borrowing more money every year and the government's borrowing more money every year and everybody's spending more than they make and leverage is going up. You can only do that for a certain amount of time. And we've pretty much hit our limit worldwide. China can't borrow too much more, and Japan is already the most indebted government as a percent of GDP in the history of the human race. And the U.S. is massively over-leveraged by almost every measure. So, there's a wall out there that we're going to hit. And at that point, then it won't matter if governments run big deficits or central banks print a lot of new money because that stuff won't do any good anymore. And when that happens, then the old system breaks down, and we have a crisis that we have to, first of all, manage, and then second of all, we've got a system that no longer works that we've got to figure out how to replace. That's when politics gets interesting. Right now it's not interesting because it doesn't matter who's in charge. It literally doesn't matter whether Donald Trump or Hillary Clinton or Bernie Sanders or Jeb Bush or Ted Cruz is in power, because these guys are largely going to do basically the same stuff, which is to borrow more money, spend more money, increase the money supply, increase the leverage in the private sector until it all blows up. So that's what we're going to live through. Someday that's going to happen, and probably sooner rather than later.
Yeah, you're right. None of the candidates are talking about, making the government smaller or cutting the deficit or doing something about the mounting government debt. They're all interested in making the government bigger and increasing taxes and, stealing wealth from Main Street.
Yeah, of course. And so, sometimes a system reaches a point where there is no fix anymore, and it just has to crash. And I think we're there because we have so much institutional momentum all around the world. You're not going to see the Europeans scale back their versions of Social Security and Medicare. Those things are going to continue to pile up debts until the system implodes. And Japan can't stop borrowing money at the central government level because then the whole economy would just cease to function, And in the U.S., if consumers stopped borrowing, that would be the complete end of the road for us. We are in inflate or die mode right now. And if we can't inflate, in other words, if we can't add a couple of $1 trillion a year to our debt, then we can't grow. And if we can't grow, we can't service our existing debts. And if we can't service our existing debts, we default all over the place. And we go back to 1930s, and so we really only have a choice between a deflationary depression that's really worse than the 1930s on one hand, and a mass devaluation of all the fiat currencies in the world on the other hand. And I think we're going to obviously choose the latter because politicians always take the relatively easy way out. And a deflationary crash is not easy by any standards, especially for the guys in charge. But devaluation, it's painful for the suckers who trusted the government and kept their savings in fiat currency, in the local currency. But for other people, it's something that you can kind of get through. And so the guys in charge might be able to salvage their careers by devaluing the currency. They absolutely cannot stay in office if they allow a 1930s-style crash to happen, though.
One thing that raised my eyebrow is that the Federal Reserve had a secret meeting in the White House with Obama last month. The meeting note from that discussion does not exist, apparently. So I'm wondering what was discussed. I assume that the president is worried about the level or the direction the economy is going, because I think he knows in reality that the economy is not doing that well. And looking at the Federal Reserve to see what they can do to get the economy revived until he leaves office, because I think we want to keep the Democratic Party in power in Congress and in the White House. So what do you think the relationship between the government and Federal Reserve has changed since the 2008 financial crisis? There's a level of mistrust between the White House and the Federal Reserve?
I have no idea what those guys think of each other. They all seem so clueless when it comes to this stuff. So either they're a bunch of people operating on flawed models and therefore completely unaware of what's going on in the real world, or they're very smart guys playing a long game in which they're actively siphoning wealth from the 99% and funneling it to the 1% with the idea of getting as much as they can before they let the system crash. And I don't know which of those two scenarios is scarier. So, what they talk about when they're alone, I have no idea. I suspect it's probably, what you hear from Greenspan and Bernanke when they make speeches before Congress, which is basically Keynesian, clueless, increase the debt as fast as we can and everything will be okay analysis, And so I suspect what they plot when they have secret meetings is ways to convince people to borrow more and more money. And, okay, that's not any more dangerous than the public pronouncements that they're making. And I don't see any way out for them, so it almost doesn't matter what they say or do at this point. They can hatch any kind of a plan they want to, short of martial law and massive asset confiscation at gunpoint, and it's all going to be the same thing 3 or 4 years from now. It really doesn't matter whether we adopt Bernie Sanders' strategies or Hillary Clinton's or Donald Trump's or anybody else's in the current political scene, because the damage is already done. We've already borrowed more than we can ever hope to pay off. So what does it matter whether we borrow more or less in the next few years? We're already basically dead as a going concern. And so the only question is how and when we recognize that the system has failed, and whether it's the market that brings about that realization, or whether the government preempts it by doing a big devaluation or something like that. Because you've got to do devaluations in secret. You have to spring them on the market without anybody catching on before it happens. So when it comes, it's going to come as a surprise. It's going to be announced on a Sunday night, or a Friday afternoon, after the markets have closed. And it'll be a fait accompli. It'll just be a done deal when the markets open the next day. And so we won't have time to prepare ourselves for it and position ourselves, which is kind of why you've got to do it now. I mean, even if it takes 5 more years for gold and silver to go up because the currencies are being devalued so aggressively, it might only take a week. It might be next week that it happens. So you kind of have to position yourself for it now and then just hope that it's sooner rather than later, so you just don't have to sit around and wait. But I don't think we have any choice but to shift gears financially now, and maybe we give up some inflated fictitious gains in the stock market in the meantime. But because when things change, they tend to change very quickly. I don't think there's time to wait until you see the change happening before you buy your gold coins or load up on mining stocks, because by that time, a lot of the big moves will have already taken place. And we saw that with junior miners just this year. You could have been waiting for the perfect entry point for a lot of these junior miners, and then they quadrupled on you before you got in. And so they still might be cheap by most objective measures, but you still missed a quadrupling. And the same thing is going to happen, but on a much bigger scale than that, when hard assets turn out to be the only thing that anybody trusts. All kinds of money is going to pour into real things and out of financial assets when people lose faith in financial assets like the dollar and government bonds. And so at that point, if you haven't done it, it's too late. So we kind of have to start making our moves now.
And the hard assets have been doing well lately, especially gold and silver. The prices have starting to climb up slowly since the beginning of the year. Gold is up a couple $100, and then silver is gone up as well. So, good to see the hard assets go up after a couple years of hardship.
It is good to see, and it's been a nice move. I feels like there should be a correction pretty soon, and we got a taste of one today. Gold was down about $20 an ounce. So another few days like that, and I would be a lot more confident telling people to load up on mining stocks, because I don't think gold can go down much from here, but it can certainly go down another $100 an ounce or something like that. But once that happens, boy, you're going to have some nice entry points for the miners again.
Oh yeah, definitely. The mining sector is a picker market right now. Just gotta be careful and pick out the mining company that with a strong business model with strong growth and strong balance sheet. So I wouldn't advise people to invest in any mining stock. Just look out for the strong one.
Yeah, mining stocks, more so than maybe any other industry outside of extreme high tech, require a lot of thought, because you can't just randomly buy them. It's not like although it might for a little while be like the dot-coms, where anything in the industry gets bid up because indiscriminate money is coming in. But in general, in mining stocks, you've got 10% brilliance and big winners, and then 90% capital destruction and eventual bankruptcy, and so you want to be in that 10%, and you want to avoid that 90%. So you can't just randomly buy mining stocks. You've got to give it a lot of thought. And if you can't do that, you should buy an ETF, a mining company ETF, although, those are kind of mechanically created, so you get the winners and the losers in there together. And so you don't make nearly as much as if you were able just to pick that 10% of winners, and there are a few people who seem to historically be pretty good at that. Rick Rule over at Sprott Asset Management is one, and there are several other guys out there who are. Jay Taylor, has been a junior mining newsletter writer for years, and he's an expert on this stuff. Those guys are worth connecting with to justify their top 10 picks. If you've got to pay a little bit or devote a little time to finding out what those guys think is going to go up, it could pay off big time in the next 3 or 4 years.
Yeah, we had Rick Roll on for a podcast past couple of times the past few years. But yeah, he's a great guy if you want to learn what mining stock is good and which one is not good. Also, another way to invest in a mining stock, if you want to play it safe, is to invest in royalty and streaming companies like Royal Gold, where they give cash to mining companies in exchange for their hard assets. So that's another type of business model. If people don't want to take the risk of investing in mining stock, they could definitely look into those type of companies.
No, you're right, Mo. I think the mining or the royalty companies are probably the best business model in the mining industry, because they and these guys did a great job in the last year of apparently picking the bottom, because they invested billions of dollars in mines owned by oil companies and big across the board basic materials miners who were really hurting. You know, they were bankruptcy candidates. Some of these miners were, and some of these oil companies were, and they were willing to sell the precious metal streams that come incidentally from their other mines, their zinc mines or whatever, to the streaming companies. And so the streaming companies got really good deals on those future precious metal streams. And I think that's going to be a really high margin business for them going forward, because it looks like those big mines are going to continue to operate, and they're going to send a lot of their gold and silver over to the streaming companies for what's going to look like phenomenally cheap prices. So I think they should be very profitable going forward. They aren't as hyper volatile as the junior miners, so you're not going to see the streaming companies quadruple in 3 months, but you could see them quadruple over 3 or 4 years. And you know what? I think that's about as good as we should ever really expect out of equity investments. You know, if you quadruple your money in a stock, you did great, and that should be fine. And you know, you do that a few times with a decent amount of money, and that's really all you need to do financially for a lifetime.
Oh yeah, definitely. I mean, I wouldn't complain if I quadruple my money over the next few years. That's better than what you're going to get in a savings account or any other return in investment.
Oh my God, yeah.
So yeah, I agree. The royalty and streaming company, they did a good job weathering the storm for the past few years, and then taking advantage of the low gold and silver prices to sort of bail out the mining stock that needed the cash. So there's a few companies, I won't mention it, that did a good job. So yeah, I agree with you. So I want to go back and talk about negative interest rates. Now, the last time you came on for a podcast, Japan just announced negative interest rate. What has been the result from that policy?
Well, negative interest rates, first of all, are an admission of failure on the part of the central bank. That means they screwed up monetary policy on such a vast scale that they're left doing crazy stuff to try to salvage their careers and their reputations. Second of all, negative interest rates are a tax. You know, as we talked about, that's a way to funnel money out of bank accounts and the wealth of individual savers and into the accounts of rich people. And so in that sense, it is the truest example of what you said earlier about taxation being theft, you know, because this is secret taxation without representation. You know, nobody voted for negative interest rates. And yet here they are sucking money out of our bank accounts around the world. So, yeah, you know, negative interest rates are first of all immoral and a sign of incompetence, but they're also a sign of impending disaster, because when rates are negative, that changes the calculus in so many ways and creates so many unintended consequences. And first of all, it causes people to hoard cash. In Japan, people are pulling their money out of banks, putting it in home safes. And so home safe sales are booming in Japan. And, you know, just as a general rule, when home safes are the hottest product on the market, that says something very scary about that society. You know, people above and beyond everything else want to protect themselves from some kind of a crisis by buying a safe. That means they're really worried about the state of their society, and with good reason when interest rates are negative. So you can't take them much more negative than this without causing some kind of a catastrophe, I wouldn't think. So two things are happening around the concept of negative interest rates. One is the war on cash, where governments are responding to people responding to negative interest rates by making cash illegal or taking steps to make cash either illegal or so inconvenient to use that people won't use it. And in that way, give the government a chance to raise or to lower interest rates even further. You know, they want to push interest rates down as far as they can and as far as necessary to get the economy growing again. And if it's negative 5% on mortgages, so when you buy a house, the bank pays you, well, so be it. You know, they'll do what they have to do. And if they have to make cash illegal in the process, they'll do that too. And that, taken to its logical extreme, leads to some kind of a financial crisis where people just don't want to deal with the usual financial intermediaries anymore. You know, so what are banks except hedge funds if they don't take deposits anymore? And so, you know, the financial system isn't going to survive extremely negative interest rates. The other thing that's happening around negative interest rates, though, is that the focus is shifting back to government deficits. Economists are starting to say, well, you know what, we've taken money or monetary policy about as far as we can take it. We can't push interest rates down much further because we're getting the opposite of the desired result. You know, you push interest rates down into negative territory, and instead of going down, the value of your currency goes up. So you didn't actually devalue your currency like you were hoping for. So we can't do that anymore. So let's have governments run big deficits and spend that money on fill in the blank, you know, infrastructure or tax cuts or whatever, you know, direct payments to people, guaranteed incomes, and which is all sort of kind of this debt jubilee that people have been talking about for such a long time. You create a lot of money, you give it to people, you have them pay off their existing debts with that money, and so you deleverage your society in that way. But of course, issuing money is a form of leverage, right? You know, a dollar is only an IOU. And so, in effect, by issuing dollars, a country is borrowing money because those dollars are going to come back and want to buy American stuff at some point. So when we issue dollars, we're issuing an IOU that somebody can use to buy our stuff. And that's what will happen if we just keep on issuing huge amounts of money and then spending it in the hopes of getting other people excited enough to borrow more money. You know, we'll just ignite a currency crisis in which nobody wants to hold dollars anymore because there are just too many of them. And so they take those dollars and they try to convert them into stuff, and we get that crack-up boom we talked about before. So those are really the only two viable scenarios from where we're headed. You know, either we push interest rates down to the point where we get a currency crisis and all kinds of unintended consequences that are all bad and the system kind of grinds to a halt, or we kind of hyperinflate by running massive deficits and financing them with borrowed money and financing that debt with newly created currency. And we end up with the value of all the major fiat currencies of the world just falling out of bed one day. And neither one of those is an attractive scenario from the point of view of somebody who has to live through it. I mean, it's fascinating from an economic theory standpoint. You know, economists will be doing their dissertations and building their careers around what's been happening in the last 30 years and what's going to happen in the next 10 years. But the people living through it will not find it that much fun, I'm afraid.
Yeah, negative interest rate. A lot of people in this country was wondering when that's going to come here, and that's something that nobody should wish for here. I guess, I mean, a lot of people are going to have to take their money out of the bank account before that actually happen, and maybe move it outside the country, or, you know, maybe move it into a account backed by gold.
Yeah, you know, one of the reasons that U.S. coastal real estate is so high right now, and Canadian, you know, Vancouver's real estate market is on fire, is because people are making the decision you just talked about in other countries. You know, Chinese people and Brazilians and Russians and Europeans and Japanese, they're all pouring money into trophy real estate in the U.S. because they're afraid of what's happening in their own countries. So yeah, you would logically move some money overseas when your country starts doing really crazy stuff. And that might be something for your listeners to consider too. If they've got a little extra capital, moving it somewhere outside of the jurisdiction of the IRS and of our Treasury Department might not be a bad idea, just as a diversification. So you put some gold bars in a Swiss bank account vault, or you buy an insurance policy denominated in some other currency and hope that currency holds up, something like that. So a Costa Rican beachfront condo would be a nice thing to have. And in that way, you diversify geographically. So that even though you can't tell which country is going to get craziest when this all starts spinning out of control, if you're invested in 2 or 3 different countries, there's a reasonable bet that one of the countries won't go crazy at all, and the other one will be less crazy than most, and only one of your financial domiciles will really do something to impair your wealth. And that's diversification. You do that normally via lots of different asset classes. And in crazy times, you do it geographically as well. You don't trust your host government completely, so you move some money overseas. So yeah, that's something that's worth doing too. But there's nothing guaranteed. There is no surefire way to protect all your capital. All you can do is put it in lots of different baskets and hope some of those baskets survive.
Yeah, I agree. Thanks to the internet, there's a lot of ways for people to move their money outside the current banking system. We have gold money. There's also Big Gold. I think Big Gold just bought out gold money. So there's a lot of tools, thanks to the internet, where people can easily move their asset outside the fiat currency system.
Yes. Yeah, there are.
So before I let you go, I just want to talk about a recent press conference that Obama did on the economy. And it was a couple of weeks ago after the unemployment number came out, which people don't know is heavily manipulated to make the government look good and to, show people that the economy is doing well when it's really not. So he did a press conference, and, he outlined how the unemployment number going down, and that's a sign of economic strength. And then he, talked about his concern how the global economy could derail all the progress that's been made in the U.S. economy in the past few years. So basically he's saying whatever happened to the U.S. economy is not our fault. It's the global economy, it's the other countries that's messing things up here, which is not true in reality. And his solution to get the U.S. economy going even further is to, one, raise minimum wage to $15 per hour, because he's saying that if you raise it $15 per hour, it will stimulate spending, and, the multiplier effect will kick in, which something that hasn't worked since the 2008 financial crisis. People have been paying attention and seeing how much money the government has been spending for the past 5 to 8 years. And then also he wants to invest in infrastructure, which is something he also promised when he was elected in 2008. So I don't know why he's bringing that up again. So I just want to get your thoughts on what he said in his press conference, and just told you how the government just don't understand how the economy works, and that central planning just doesn't make anything better. Doesn't make things better for people on Main Street.
Yeah. I think that it's pretty clear whenever you listen to anybody in government speak now that they're operating with a model that doesn't match actual reality. And the minimum wage thing is interesting because, I think if you just let companies run wild, corporate history shows that they will abuse their workers. And so a basic set of labor laws is probably crucial to capitalism remaining something that people will vote for. So in that sense, a minimum wage might be part of that package and might be okay, but people don't seem to get that when you raise it, the the people who continue to work make more money, but you end up costing the system a lot of jobs. And it's the people who are least able to afford it who are hurt. Because basically, if lots of people are out there working that companies are willing to give $8 an hour to, and you raise that to $15 for everybody, some of those people just aren't going to be worth $15 an hour to the companies that they work for, and the companies are going to fire them. And those are going to tend to be the most vulnerable people. So that when, let's say there's 1 million jobs at $8 an hour out there, and you raise the minimum wage to $15 an hour, you might end up with 600,000 $15 an hour jobs and 400,000 unemployed people. Now, that might or might not be a trade-off that is acceptable, but you never hear anybody put it that way when they're talking about it. They just say, oh, we're going to make sure you make an extra $4 an hour. But they don't say, if you keep your job, you might be laid off. There's a 40% chance you'll be laid off, but if you keep your job, you'll make an extra $4 an hour. Then it wouldn't be quite as popular. And that's true of a lot of regulation. We need good, basic, clear, transparent, honest regulation of businesses, obviously. I mean, you aren't allowed to dump battery acid in the river, right? That's a basic regulation that everybody understands and everybody agrees with. But when they get really arcane and really opaque and have all kinds of carve-outs for special constituencies, and the companies are hiring the regulators away in order to then put them to work fooling the next generation of regulators, that's when you get a problem. That's called regulatory capture, basically, when companies spend money in order to game the regulatory system and make money by carving out special exceptions for themselves and special barriers for their competitors. That's the kind of thing that we have going on now that makes it really hard to trust the system or even to understand the system. So hopefully part of the process of sweeping away all this edifice that we built up over the past 40 or 50 years will include the really outrageously convoluted and corrupt regulatory systems that we build up now. And, I don't know what part the minimum wage will play in all that. I assume that we'll have basic protections for workers in whatever comes next. At least I hope we will. But hopefully it's very clear and the trade-offs are very well understood so that people can honestly and with a sense of understanding, vote whether they want one piece or another piece of the puzzle to be put into place.
Yeah, and Wendy already announced that they're going to implement machines instead of having cashiers to offset the raising labor costs.
Yeah, we're at a really scary time for low-end workers. For the people who are on the lower rungs of the economic. I'm a lot older than you, but back in my day, you could just show up if you were able-bodied at a foundry, at a factory on the edge of town, and they would take you on and hire you, and they'd pay you reasonably decent money by the standards of the time and place. And now there's nothing like that. You can't get a middle-class job in manufacturing anymore if you're a high school graduate. But the other jobs are being automated away. Amazon has almost completely automated its factories. It's all just robots there. And Amazon is putting the regular retailers, the brick and mortar retailers, out of business. So you're seeing Macy's and just today Target reported bad numbers in their stock tanked. And so the stores that used to hire people are going out of business, and the e-tailers, the e-commerce companies that don't need people to any great extent are taking over. And that's happening in all the formerly entry-level parts of the economy. So it's not clear what happens going forward, because robots are just at the beginning stage of what is going to be a really exponential increase in their capabilities. We're going to have robots being able to do much of what humans do in another 20 years. I'm actually writing a magazine article right now on the automation of money management. And robots are encroaching on financial analysts and money managers now. And, of course, investment bankers and position clerks and, and paralegals. Lots of other information work is being automated away. But even judgment stuff like money management is being affected by automation. So there's not going to be any place to hide pretty soon. But the minimum wage guys, today's minimum wage workers, are the ones who are really going to suffer, because there is going to be nothing for them 10 years from now when they get laid off from their McDonald's job.
Yeah, there's going to be a war against the machine pretty soon.
Well, yeah, even cab driving. If you've been in New York City lately or ever, you know that that's what an immigrant does when he moves to New York City. He starts driving a cab, right? It's the quintessential entry-level job. Well, when we have self-driving cars, even Uber drivers aren't going to have work pretty soon. And self-driving cars are coming along faster than anybody expected. You know, they are on the road now, and they're being put on the road in fleets prospectively. You know, in the next couple of years, there are going to be companies that run fleets of trucks that are automated, and soon it'll be cabs, and then it'll be regular. You know, it's going to come. And so there's another entry-level job that's just not going to exist. It's a really scary thing, both from an individual standpoint, if you're one of the people affected, and from a public policy standpoint. How do you manage an economy where the entire lower 3 or 4 rungs of the economic ladder are being automated away, and there's no human jobs there anymore?
Yeah, it's going to have a lot of negative effect on the economy. A lot of jobs would be lost, but the automation would at least, I think, would improve standard of living for humans. I think it will, make things cheaper, since their labor costs will come down and things become more efficient. So there's up and down about the ride of automation.
Well, yeah, that's the trade-off of automation. It makes us more efficient, stuff gets cheaper and more available. But historically, it's created as many jobs as it's destroyed. And so the question now is, will that relationship continue, or are we going to see a burst of automation that is so powerful and so pervasive that it swamps whatever jobs it creates? And I think that, machines making machines, for instance, and the automation of the manufacturing industry through, for instance, 3D printing, that closes down whole factories where you can just make whatever you need on your desk, like with the way you print out sheets of paper right now. And there just won't be that many jobs. At least there doesn't seem like there will be that many jobs for people picking things up and moving things around and tightening screws and stuff like that, the way there used to be, or cutting hair or serving drinks or bringing food out from the kitchen to the restaurant table. Once that stuff goes away, and it largely is going to go away, it's not clear what replaces it.
I think there'll be jobs created out of the automation. I mean, if the robot breaks, humans have to fix it.
Oh, no doubt. There will be humans involved in that process. There will just be fewer of them than, say, the number of bartenders that get laid off, or waiters, or whatever. I am just speculating. I don't know for a fact that any of this is true, but it definitely seems like that's where we're headed, and that it really complicates both policy making and personal planning for individuals, because you don't have that first ladder to step on and work for a few years and then move up. And I don't know what it all means, but it doesn't seem good at the moment. It's great if you have money, by the way. Technology is, we're going to have massive, awesome virtual reality rigs available to us, and Tesla electric cars and stuff like that. So for the people with money, this is going to be a wonderland in the next 10 years. I mean, technology is just going to give us so many cool toys to play with. And
definitely. I've already seen robotic bartenders. I think on cruise ships they have them now. So I guess in the next decade or so, those small talk you have with bartenders are going to go away.
Well, they're going to be able to mix drinks, but they will also be able to make small talk. That's the creepy thing about this, or not the creepy thing, really the astounding thing about artificial intelligence, that they're progressing towards the ability to have a very reasonable conversation. And, there's the Turing test where you have a conversation with someone on a screen or on the phone or whatever. And if you can't tell it's not a human, then it's intelligent, whatever it is that's talking to you. If it's a machine, then it has achieved intelligence. And we're getting very close to simulating intelligence to the point where it's sometimes hard to tell whether we're talking to a machine or not. So an empathetic, witty bartender who's a machine is not that far off, I don't think.
Yeah, you're right. I think Japan opened up a hotel that's run all by robots. So the front desk has robot taking your, processing your, giving you the key to the hotel and stuff like that, and then it'll be maid, or be robot, or bring you towels and stuff like that. So Japan's already further ahead than everybody else on that area. So yeah, I agree on that one. Well, so John, I appreciate your time, and if people want to find out more about your work, where can they go?
I run dollarclaps.com, and it's kind of continuously updated site that covers most of the stuff that we talked about. So, check in there in the morning and hang out for an hour, and you're pretty much up to speed on the ongoing financial crisis.
Okay, great. Well, thank you, John.
Thanks, Mo. Enjoyed it.